Investing is widely thought of as a way to bolster finances and provide a form of financial security. The type of investment strategy you choose will depend on your goals, capacity, and risk tolerance. When you are ready to begin investing, start by setting goals and creating a savings plan. This will help you narrow down the types of investments that suit your needs. Index and a few. Investing is an excellent way to boost your financial health, whether it's by adding savings, investing in real estate, or earning more money from investments. It's important to choose the right strategy though, since each one can have its own risks and benefits. There are investment strategies for almost every level of involvement and risk tolerance, from buying index funds to hiring a professional. However, finding the right strategy for you can be difficult. The best option for many beginners is to buy into an index fund. Index funds are a type of passive investment strategy that track an entire market segment. They are often low cost and can be a great way to diversify your portfolio without much work. However, it's important to note that index funds aren't guaranteed to grow your money. In fact, they could lose value over the long term. A more active form of investing involves making individual stock or real estate purchases. This type of investing is popularized by the home flipping shows on HGTV and other similar types of investment opportunities. It requires a greater degree of involvement and research, but it can be a good option for investors who want to take the time and effort. Another option is to use a combination of both active and index investing. This can be an effective strategy for beginners because it can offer a balance between risk and potential returns. It is also flexible enough to allow for changes to your investing approach as your goals change or as the market fluctuates. For example, you might choose a safe index fund for the majority of your portfolio, while dedicating a small portion to an actively managed investment that can deliver more significant gains over the short term. It's important to remember, however, that changing your investment strategy can create taxable events and may limit the growth potential of your portfolio. It's also a good idea to review and rebalance your portfolio on a regular basis to ensure it stays in line with your risk tolerance and long-term investing goals. Buy and hold. The buy and hold investment strategy is a time-tested method for building long-term wealth. It involves investing in a company or fund that is expected to grow over the longer term. It is a low-cost passive approach to investing that may be suitable for beginner investors who are not comfortable actively managing their portfolios. This strategy also provides a tax advantage for many investors, as long-term capital gains are typically taxed at a lower rate than short-term gains. This investment strategy may be best for beginners who are looking to build long-term wealth with the potential for a high rate of return. It can help mitigate the risk of a volatile market by keeping investments diversified over time. It can also help reduce fees by avoiding frequent trading, as each transaction costs money. With this investment strategy, beginners can focus on researching and selecting a few options that seem promising to them. They can then stick with those investments over the long term, regardless of market fluctuations. This is in contrast to active investing, which often involves making changes to a portfolio in response to a company-specific or broad market news event. One disadvantage of this investment strategy is that it can be difficult for investors to stay disciplined during a period of weak or flat market performance. As a result, beginners should carefully research the stocks they are considering and have a plan in place to stay invested even during periods of low market returns. Investors can use a variety of approaches to practice this strategy, including passive index funds and exchange-traded funds, ETFs, mutual funds and individual stocks. It can be helpful to research each investment before deciding on it, as it is important to understand exactly how each option works and how it is managed. It is also helpful to know how each option is regulated, as this can influence an investor's investment choices and risk tolerance. It is also important to remember that any investment comes with some level of risk, and there is always a chance that an investor will get back less than they invest. It is important to be realistic about these risks and to develop a diversified portfolio that is suitable for their own investment goals and risk tolerance. Income investing. When determining an investment strategy, it is important to understand your financial situation and goals. How much are you trying to save? How long do you have to invest? Your time horizon, and what risk can you take? Once you have that information, you can start looking at different types of investments to find one that fits your needs. There are many options, from stocks and bonds to real estate. Each has its own pros and cons. Income investing is a popular strategy for beginners because it can provide passive income. However, it is important to remember that income investments typically have lower returns than growth-oriented investments. The lower return is due to the fact that income investments are usually less volatile than other investments. The most common income-producing investments are dividend stocks and interest-bearing bonds. The former typically offer steady income from regular dividend payments, while the latter pay out a fixed amount of money at a set rate on a monthly, quarterly, or annual basis. Investors may also choose to buy and hold real estate, mutual funds, or even gold or collectibles as part of their income-producing portfolio. Beginners should note that some income-producing assets carry higher risks than others. This is especially true for investments that offer exceptionally high yields. While these investments may pay out a good return, they could be susceptible to default or inflation risk, or simply not keep up with the cost of living. As a result, income-producing investments should be included as part of an overall portfolio strategy that includes growth-oriented investments in order to achieve the best results. A common strategy is to build a bond ladder by purchasing bonds with short, medium, and long durations. This strategy helps reduce overall risk and provides the flexibility of reinvesting the proceeds from each bond as it matures. Ultimately, there is no such thing as a free lunch in investing. While the potential for greater income with an income-focused strategy is appealing, it comes with a trade-off: lower investment returns than those of a growth-oriented approach. Growth investing. Growth investing aims to find stocks or other assets that have above-average profit potential. While a growth strategy can provide higher returns than other approaches, it also poses more risk to your portfolio. If you're comfortable with the risk, this type of investing may be a good fit for you. Growth strategies tend to target smaller companies that are expected to grow faster than the industry average or the broader market. These investments often feature high profit margins, solid revenue, and impressive sales numbers. Companies focusing on innovation also qualify, especially if their products are expected to change the way consumers live or work. Investors employing a growth investment strategy focus on a company's earnings, which is what is left over from production, marketing, operating, labor, and tax costs after subtracting out the cost of goods sold. A company's revenue growth and future forecasts are also important, as they give a glimpse into the company's long-term profitability potential. The types of assets that can benefit from a growth-based investment strategy include small-cap stocks, technology companies, and companies in early development stages of innovation. These companies are typically in the process of breaking into new markets, which means their earnings can increase substantially over time. This is why these stocks usually offer the most attractive potential returns. This type of investing is often compared to value investing, which involves finding stocks that seem to be trading for less than their true worth. However, it's not uncommon to see investors use both value and growth investing in their portfolios, as different strategies can complement each other in certain times. Choosing the right investment strategy is crucial to your financial goals. You can begin by researching the nuances of each approach and then selecting one that matches your risk tolerance. Keeping the long term in mind, you'll want to select an investment strategy that aligns with your financial plan and gives you the best chance of reaching your savings and spending goals. If you're unsure how to start, consider talking with a financial advisor. Smart Assets' free tool connects you with financial advisors in your area, who you can interview at no charge to determine if they're a good fit for you.